Well, guys, it's 6 o'clock, so let's go ahead and begin. It's good to have you with us. I think we'll be joined by some others, of course. My guess is the absolutely beautiful late spring evening following the deluge of the last few days is kind of drawing some people outside, but they'll probably be with us, I would think. So let's go ahead tonight and start by talking about the problem set, the project investment selection. Not only do I want to perhaps take questions with respect to it, but I want to talk about some of the issues that I see in this now that you have familiarized yourself with it and are in a better position to discuss it. Any of you have any questions that I can answer with respect to it before I start to talk about issues?
Okay. Yeah.
Nothing. Okay. So I'm curious, Kate, which investment would you choose out of Dawn Treader, You Can't Get Enough, and By the Way boutiques?
I picked You Can't Get Enough.
The fastest way I know to lose money, Kate, is to
Well, I work in food and beverage, so I had a lot of previous knowledge that helped me confirm that those growth rates were correct.
Good for you. Okay, I like that. I like that. Now, is that real or are you just shining me?
I really do work in the food and beverage industry, but
okay. Now, and remind me what you do, if you would, please.
Sales and events manager for one of the ski resorts.
Oh, very good. Okay. So, all right. So you like this because you believe the growth rates. That's interesting. Okay. At what valuation? How much would you offer for it?
I didn't propose a different original investment value. I just said that the sorry, I'm just pulling it up here, that the 15 million was acceptable.
Okay. So you're going to play buyer and I'm going to play seller. Fair enough?
Perfect. Sounds good.
And you have offered me $15 million. So Kate, I know that you're pretty astute when it comes to numbers. And I'm going to share with you guys my screen for a moment so that you can see what Kate has valued this investment at. And because she has said that she believes the projections. And I'm going to guess that means you also accept the discount rate.
Yeah.
Okay. So Kate, are you cheap? Are you purposely usurious? Or are you just trying to create enemies? Because you're offering me $15,000 for something that you have valued at 42 million, almost 43 million. So you're offering me roughly a third of its value. Is that right?
I think it's $15 million.
Oh yeah, that's what I meant. $15 million
okay.
For something that's worth.
I'll take it for 15,000 if that's the.
Kate, you misunderstand me altogether. So in fact, honestly, Kate, I'm offended. I'm not even going to give you a counter offer, given that you have told me you believe it's worth 43 million, but you're only offering me barely a third of that. Is this how you do business usually?
Well, isn't that what you offered me? So I'm just a really good investor. I'm going to jump on the opportunity because I can buy in at 15 million and I can make 40 million. So
I don't remember offering you anything. You came to talk to me about buying my restaurant group because you're already in food service. Okay, we're playing a game now, right? Okay.
Yeah.
Okay, good. So here's the thing. Is a $15 million proposed valuation reasonable for something where we have estimated a $43 million valuation? And Mandy, you're shaking your head. How come?
Because whoever did that valuation either doesn't know what they're doing and is very off, or you need to be more honest, or you, like you said, you'll make enemies.
Well, tell us what you really think, Taft. Okay. So I'm gonna suggest a couple of things, Kate. Maybe 15 million is not so bad. And we're going to start to expose what I think some of the issues are with this particular structure. How do you feel about forecasting out 10 years of cash flows at 10%? Are you comfortable with a 10-year forecast? You have quite a few analysts with you. This is some of your senior team, your investment advisors. So any of them can jump in to help you out here. What do you guys think? Do we like a 10-year forecast?
No.
No, typically no, right?
Why not, Taylor? What don't you like about it?
Well, I mean, just given some of the past things we've talked about, markets change pretty drastically. Anything past 3 or 5 years is pretty sketchy to say that you know with confidence how a market can grow or a business can grow. And also, just the industry seems like it fluctuates a lot with market demand. And so it's not like an industry that has been constant for decades, right? It's something that we see changes fairly often.
Right. So Kate, you got some knowledge in this industry. You indicated that you are okay with the projections. Do you think that 10% is what you can get over the next several years? Or are you just thinking that 10% is a number you're willing to use in a 10-year projection, and that really you think you can get much better than 10% in the next several years as you might buy into this company?
So I agreed that I said I can confirm that there is a long overdue focus on barbecue grits and Dr. Pepper, and previous personal and professional experiences confirm the reliable prediction of a 10% cash flow growth for at least the following 10 years.
Well, you happen to be tugging at my heartstrings if you're talking about the top of the food pyramid. Let's be honest with each other, okay? So, all right.
But then there's also like a long-term growth rate of 6%, which is still good. So it's like slow and steady. 6% sounds fine if you're going to keep making money. So
yeah, you're talking more like a seller than a buyer, Kate. I want to teach you to talk like a buyer. I'm going to be the buyer, you be the seller, okay? Ms. McConey, I appreciate that you've used a 10-year trajectory here. Honestly, my guess is that if we're going to use a 10-year trajectory, we really can't do this at 10%. 10% over a 10-year time frame just is not realistic. I'm willing to consider this at maybe 7% over that time frame. And moreover, I can't buy into a perpetual growth in the restaurant industry, which is renowned for low profitability and low growth. So I've got to move this long run growth rate out to about 2.5%. And moreover, my experience, and you know how I feel about this, I don't love to invest in restaurants. My experience is that if I'm going to invest in a restaurant, I better be able to see a really interesting return, or at least the potential for one. So I got to move this to about a 20% discount rate for me to even think about it. And in doing so, I am willing to offer you $15 million because I'm offering you, frankly, a little bit more than I think it's worth, because I think it's a good restaurant and I'd like to buy your goodwill so that you can help me during the next 2 years of transition. So I'll pay you $15 million. But Ms. McConey, I believe that this company is only worth $13.5 million. That's how a buyer talks. A seller talks the way that you were talking. Okay, does that make sense to you guys? And I knew that Kate had some rationale, which is why I picked on Kate, and I knew that she'd have the backbone to step up to it. So thank you for doing so. But do you see the difference, guys? Now, frankly, I will tell you that structurally, a 10-year projection is an awfully bold move. Frankly, even over here in Dawn Treader, an 8-year projection is a bold move. So So not only do I think that you've got to be prepared to understand the dynamics of changing the inputs to meet your situation and meet your position to tell the story you want to tell. And as a buyer, the story I want to tell is, yeah, I like your company, but I don't like it at that price. As a seller, Kate wants to turn around and say, well, wait a minute. The capital costs of my components are 12%. And I see industry research that tells me that 10% is realistic. I mean, the baby boomers have been ruling this market for a period of time. And just as I've heard, in fact, headlines in all the major newspapers and on television, grits, barbecue, and Dr. Pepper have been given their rightful place atop the food pyramid. So there's a lot of growth is going to be here. And maybe I'll buy into this 2.5% long-term deal. So if at 15 million, this is an extraordinary bargain because it really should have a value of more like 32. That's the way a seller would talk. Do you see the difference? Okay. Anything you want to offer in here, Kate? Or you just want to sign the check? I'm okay if you sign the check. It's all right.
Yeah, I liked it at 15. I think everything was reliable, and also I just added in some other stuff that I made up to make it even more reliable. So I'm good with my 40 million for 15.
Okay, good for you. I'm happy for you. I love that. So let's talk about some structural problems that these have. And I'm going to start with Dawn Treader Enterprise. Anything concern you about Dawn Treader Enterprises? Okay.
Well,
Sorry, they are forecasting for 8 years, and 8 years is also too much, I think.
It's long, isn't it, Diana? Now, in this case, I think you have some information telling you that they felt comfortable in an 8-year forecast because of some government contracts. Okay. So in that case, I might be willing to do that. I might even be willing to look at this $5 million loss for 3 years. And then this movement to 3.5 million, again, on the strength of existing contracts. And I might even be able to warm up to 35% growth rate, again, if that's based on the strength of the contracts. And as it turns out, the contracts that this company is dealing with are some Department of Defense contracts. So those things are virtual gold, right? But does it make sense to us, A, that we would move from 35% to 8%? And does it make sense to us that 8% would be a perpetual growth rate? What would have to be the story of this company to believe that we're going to grow at 8% forever? David, any idea about that?
I mean, pretty much the expectations that, I mean, an 8% perpetual growth rate, the company's going to be killing it, so to speak. I mean, the idea, especially if they're getting government contracts, is that they're going to be perpetually getting more and more and more contracts throughout that time period. And it's not realistic to expect 8% growth, especially given economic cycles.
And you would be a good buyer, okay? So why don't you be buyer and I'll be seller? So I think you guys know, so David, you're aware, of course, that this company, Dawn Treader, is in the green energy space. Our killer app, if you will, our big innovations are within battery storage. And we see decades of growth in the battery storage market as we deal with wind energy, as we deal with solar energy. The problem isn't creating the energy. The problem is storing the energy so that consumers can use it on a reliable basis. And there's another problem of transmitting the energy over long distance transmission lines. But this company is in that space. I don't know if you read the fine print. The company's also in the drone space. And in fact, its drones have a market advantage over others in the marketplace, not because they're better looking or because they're faster, but because our battery technology lets us put more useful battery life in the same drone for the same number of pounds that other companies are putting in with twice the weight. which means it can fly half the distance or half the time. So we've got some competitive advantage there as well. So I'm good with my 35%. And to be honest with you, I think we've undervalued this because we're not going to drop from 35% to 8%. We're going to go from 35%, probably worst case, down to about 30 or 25, and then down to maybe 15 before we ever approach the 8s. So really, I think at a $24 million valuation or $25 million valuation, this is a freaking steal.
Then you're lying to yourself.
Oh no, I've got government contracts. I've got
No, I know.
technology. I've got innovation. My
Right.
biggest clients are the Department of Defense, the U.S. Geological Survey, the U.S. Cattle Ranchers Association, the entire National Park System, the Department of the Interior. I mean, those are all our clients.
Yeah, and that's fair to say. And, you know, in my opinion, for 4 to 8 years, you know, giving yourself a 4-year kind of ownership of the marketplace. But after that timeline, it's highly likely that the marketplace is going to become overly saturated with lower priced alternatives that stem from over the seas, cross-border, and, you know, in reality, continuing to believe that perpetual growth is going to happen is just, it's just not realistic given general trends within any marketplace.
Well, are you suggesting that the patents I have on my technology aren't as strong as patents have proven to be? I mean, I've got some technology, some innovations here that are just killing it, as you put it.
Yeah, and they may very well do that for, you know, 4 to 8 years, like you suggested. But given the technology space and how quickly, you know, that changes, you know, relying on individual patents for more than 4 years is probably, you know, at the detriment to the company, right?
Well, you know, I have to admit, it's a little hard to argue with some of what you're talking about. I mean, you seem to have a clue. But I guess maybe one disparity I see here is I'm showing a 20% discount rate, which would suggest quite a bit of risk, right? But I'm seeing government contracts. Shouldn't that discount rate be lower, David?
No, government contracts are super high risk because it's a bidding war. You know,
Well, we won the bidding war. We have the contracts.
Sure, but that's only for 4 years, right? And through that time frame, after the 4-year period, there's a lot of uncertainty if the company is going to be able to continue onward with those government contracts, given that there's likely to be more companies that enter the market, as well as, you know, continuing to undercut wherever your current prices may be.
Okay, so guys, everything he's saying is plausible, and he's going this exact same angle that I might go. Only I might add one more thing to this. Those $5 million in annual losses scare the bejeebies out of me. You want me to believe that you're going to magically immediately come to $3.5 million and then grow at 35%? I'm trying to get over the bloodbath of a $5 million loss each year. So that's the only other thing I would add to that argument, David. But otherwise, I think your argument was very sound. Now, and I also think it argues that you wouldn't pay $25 million. You would probably come in and offer to pay something less, right?
Yeah,
You're a good capitalist. And I wouldn't be proud of you if you offered me full boat, right?
Right.
Okay. So that's a little Don Treader, and you can't get enough. I mean, you see some strengths and weaknesses here. So let's move to By the Way Boutiques. And we're not going to play this game. I just want to kind of talk about some issues here. I will tell you that By the Way Boutiques scares me more than You Can't Get Enough Enterprises. Any ideas as to why?
Is it because they're projecting 20% in perpetuity?
Well, that would be one screaming red flag. Okay.
Not to mention the 20-year forecast.
And now we have two screaming red flags. So we're forecasting out 20 years, and then we're putting it out at 20% in perpetuity.
And then they are valuing it at 90 million. That's a lot of money.
Well, it is a lot of money, but I mean, look at this. We've got some huge cash flows projected, right? So if those cash flows are real, shouldn't the valuation be good? What do you think, Andrew? What do you like or hate about this deal, Andrew? And then we'll come to Matt.
Well, first of all, as you say it in the text, you don't understand the market. So, but maybe because it's growing really fast, maybe the pace that this business is having is really high, and you don't, maybe it can't keep up. Maybe not, but.
Okay. So I'll tell you that from my perspective, I look at this, and whomever owns this company currently and is trying to pass it off with these values, I look at them and say, I can't even think about believing you, because what you're showing me is non-credible. You'd never have a 20-year growth period, and you'd never have a 20% sustainable growth rate, would you? It just defies logic. Just defies logic. So I wouldn't even, personally, if it were me, I wouldn't go any further. I would just say no thanks, turn around, walk away. Just because I'm not going to do business with these people. I know that they don't know what they're doing. They just don't. If they've been making money, it's just because they've been fortunate. But they strategically don't know what they're doing, and I don't understand the market. But we've got something even worse happening. What is it? Can you see it?
Is it the 0.20 twice?
Well, it's not that it's 0.20 twice. That's not the problem that is screaming at me. But one of those 0.20s, the second one, is loud, and it gets even louder when we interact it with the 0.18. How come?
Your growth rate is bigger than your discount rate.
My growth rate's bigger than my discount rate. And in my Gordon growth model, which we rely on so heavily, then my R is less than my G. So that means the denominator of my formula is going to be negative, which means my continuation value is going to be negative. And I don't care how fast you grow this this revenue stream or this cash flow stream. If the growth rate is bigger than the discount rate, then you've got a negative valuation, and you're going to end up with, or rather you got a negative continuing value, and you're going to end up with a negative valuation. And you can't outrun it. If the discount rate is less than the growth rate, the more you try to grow this, the more negative the continuing value becomes. Because growth is even bigger, and it's even that much more than the discount rate, so you cannot outrun this particular freight train. It is going to get you. Okay? Michael Schwartz, is it necessary for us to have gone through and done all of this in order to come up with this negative $300 million?
No, you could have just, because the growth rate is less, you could have just started from there, right?
Well, I don't know that because the growth rate is less, but you're awfully close, Michael.
Or it's because these two are this, I can't remember. We talked about it last night. Was it
You're right.
because these two are the same?
Yeah, so when your explicit period growth rate is the same as your long run growth rate, you only have one growth rate, right? We don't have two. We've artificially split it up. Well, if you've only got one growth rate, a constant rate of growth at a given discount rate, why don't we just apply the Gordon growth model right here and now? And end up with the same negative $300 million. Okay? So one of the reasons that I constructed this particular part of the problem set is to cause you to think about the lack of credibility of a 20-year projection. Another is the lack of credibility of a 20% perpetual rate. And another is to look at this and say, we didn't have to do all of this. We could have simply done everything with 3 terms in a very simple Gordon growth equation. Does that make sense?
Yeah, I just have one question, Rick.
Please.
And this is kind of more like a general question about like how companies operate and how like what you would derive when you see this. So I know in last week when we looked at, we were just talking about cash flows and we were talking about how some companies, right, might have negative cash flows because they're, like you use Tesla as an example, right? Because they're constantly reinvesting in themselves. So when I kind of wrote up my analysis for, I can't remember which question it was, one of my thoughts was, well, okay, not only is the 20 years and the 20%, let's just say it was even 10 years and it was 20%, right? The 20% seems unrealistic, but doesn't that also say to yourself like, okay, well, that means they're either not reinvesting any of their cash into their company and they're still growing at 20%. That doesn't seem like that passes the smell test. And if they were reinvesting some of it, then that means they're projecting cash flows that, you know, if they, you know, that I guess in real terms are really even higher than they look here because they're not accounting for what they're reinvesting. Like to me, if you're going to project that you're growing that much, like you either have to have massive demand from the market, like exponentially, which is almost impossible. You have to have like the most, you know, inelastic product possible, or you have to be like expanding and growing and you know, reinvesting in yourself. So I'm just wondering, like, is that a reasonable conclusion to come to?
Well, kind of, but I'm going to take it from a slightly different angle that doesn't undermine what you said. It gives kind of a counterpoint to what you said.
Okay.
If a company's growing at 20%, does it seem reasonable to you it would only have an 18% discount rate? Or if it's growing at 20%, don't we think that we might actually see a discount rate of greater than 18%?
Meaning
all of that growth breeds risk, right? We're putting more and more and more at risk when we're growing. Doesn't it seem to you that a discount rate of greater than 18% might be reasonable here?
So yes, if my understanding from what you're saying is that just like any opportunity, you know, the basic logic is why would you have such a high return on something that was low risk? And when I say low in comparison to its growth.
Lower risk.
Right.
Yeah, exactly.
That makes sense.
So I think that if you want to try to rebuild this and undermine my attack of it, that's where you start, is by saying, hey, you know what? This inverse relationship of R and G that's so problematic here, we've got a structural problem. We can't reasonably believe that R is 18% when growth is so robust, because that much growth must mean there's a lot of risk involved. Okay, otherwise we wouldn't be getting it. So you might be able to argue for 25%, and all of a sudden we have a whole different ball game.
Right. So like in mine, I picked this one as the one that I would invest in, but I made a bunch of changes to what the valuation would be, but that's one that I completely missed. So what I could have done is I could have said, well, I'm okay with these assumptions, but they need to change what the assumption is that the WACC is going to be, or the discount rate. Like that's one of the ways I could have changed the valuation.
And if it were me, if I was willing to consider this, I probably would amp the discount rate. I would keep the explicit periods growth rate maybe of the 20%, because it looks like they've got some track record for this. Because remember, they've been operating very profitably up to now in their brick and mortar stores, and now they're opening up an additional internet-enabled marketplace on top of the brick and mortar. And so, but I would reduce the explicit period to maybe 4 years, maybe. And I would take that long run growth way, way down, 4% max. And then I would look at my number. I know that you already know that any detail in any contract is negotiable, right? You know that. I want you to know that any detail in any valuation estimate is equally negotiable. because it's an estimate. If it was a historical artifact, it'd be harder to argue with, right? But it's an estimate. Anyway, I hope this gives you kind of a different perspective on how you might already be thinking about this. My guess is most of you have already finished this up and you've submitted, or you're ready to submit, and you've given your rationale. There's a whole bunch of correct rationales. There might be some incorrect ones, but more than anything else, I wanted you to have to practice the multi-columnar structure here a few times. I wanted you to see some obscure problems that might come up with it, and I wanted you to think about what decision criteria you might use in determining which investment you would make. That was my goal here. Okay. Any questions that you might like to ask about the other items we're working on at the moment before I go into looking more at what we did last week and then moving on a little bit? Okay. Well, in that case, let's find a way to move on.